Good morning, everybody out there in Radio Land, as I like to think of it. You've just had a very interesting interview with the Executive Director of the World Bank, and you've listened to that. We haven't been able to listen to it, unfortunately, because we've been chatting here in our green room for our panel discussion. Central and Eastern Europe in focus, future capital markets, public finances and public debt are the topics at hand here. We've got four sovereigns represented, four guys who are in charge of debt management, essentially, for their respective countries, and three other players in the market. I'm going to introduce all of them in a second or two. This whole morning, this whole session that you're tuned into is part of OMFIF's Funding a New Era for Europe series of events. Obviously, we're looking at CEE now. Some of the countries are EU countries, some are not. We have one country represented who's a Eurozone country. But of course, it all comes against the backdrop of this massive tidal wave of new debt from the new European Safe Asset, Next Gen EU, and so on. So that's part of the broader umbrella under which we're having this discussion focused on Central and Eastern Europe. So let me introduce who we've got. They're all dotted about on the screen, as you've all done this yourselves, I know, so you're familiar with this. Yuri Butsa is here from the Ministry of Finance of Ukraine. He is the guy who is, if Ukraine had a DMO, he would be it. Marian Divjak is here from Slovenia. He's Director General of the Treasury Directorate in Slovenia. We have Odilbek Isakov, who's Deputy Minister of Finance for the Republic of Uzbekistan. You don't know all these people, their names are on the screen, I'm sure. Give us a little wave, Odilbek, so everybody knows it's you.
Yes,
there we
it's
are.
Me.
That's him. And last but not least, representing the sovereigns, we have Zoltan Kureli, who is the Chief Executive of the DMO of Hungary, AKK, and indeed, helpfully, Zoltan has AKK right behind him. Then we have Attila Farski, who is Executive Director and Head of Capital Markets Origination at Raiffeisen Bank, who are very kindly sponsoring this event. And there's no prizes for guessing who he is, because over his left shoulder, he has a big yellow flag that says Raiffeisen. We have Magdalena Polan, who is the principal and lead economist. Yeah, there she is. Magdalena is easily identified and has her books behind her. She represents Prudential or PGIM or PGIM, or however you want to think of it. And last but by no means least, Alexander Pivovarsky is the Director of Capital Markets Development at the EBRD. And where are you, Alex? There's Alex. He's waving. So thank you all very much for joining me, for joining OMFIF on this session. We're going to talk for about 90 minutes or so. Audience, of course, are invited to put in questions, and those will be fed to me by my colleagues who are monitoring all the chat room functions. But just to get us going, what's curious, at least it seems slightly curious to me, is that four of us here were on a panel 16 months ago when all of this stuff began. I mean COVID pandemic. And the views of the three panelists that are here with us, who are Marian Odilbek and Yuri, were all pretty benign. I mean, the general thought was that pandemic wasn't going to hit Central and Eastern Europe terribly badly. It hadn't done so by the time we were talking, which was the end of May last year. And I wonder how people are thinking about it now. Of course, the hit of all of this was not by any means clear in May, June of last year. But it may even be that some of you are surprised on the upside. So I just want to start with the four countries and ask you, please, just to give us a snapshot of the arc of economic recovery that you're seeing in your country and region-wide, if you wish to address that. So, Marianne, I'm going to start with you because, as we will all remember, those of us who are paying close attention, Slovenia was the first country to declare the pandemic over. perhaps a little prematurely, but looking back now, just give us that snapshot of the arc of economic recovery for Slovenia, please. Over to you.
Hello to everybody from Slovenia. Christopher, indeed, we were optimistic when speaking back in June 2020, but we were not optimistic enough, I would need to say. Slovenia is doing significantly better than we expected during this period. Economic activities dropped for 4.2% in 2022. The economy is expected or forecasted to grow 6.1% this year, 5+% in 2023, and 3.3% in 2024. So the prospect for Slovenia economy is very good. Also, other figures like general government debt are significantly better than expected. So we are making our own projections for the debt level. We are actually keeping certain reserves inside this forecast, because we believe it's important to actually meet targets securely. So in this context, all good in Slovenia. I'll give an example. Yeah.
Let me just ask you, did you become more pessimistic and then optimism grew?
Yeah, I did, yeah.
One question. And second question, just really quickly, what sectors mainly are driving that growth picture?
Across the board. So the actually production sector is actually helping a lot. So it is domestic demand which is adding things. So it is construction sector. Investments are on the rise in general in Slovenia. So across the board, I would say. Tourism is back to pre-COVID levels. So I wouldn't want to actually single out one of the sectors.
Okay.
Would also like to point out that unemployment is really low. What we forecast this year is 4.7 ILO methodology.
Well, we could do with some people over here to drive some lorries around, and they could do with some people in Silicon Valley to turn Facebook and WhatsApp back on. So if anybody is looking for a job, there's plenty out there. Odilbek, how did this go in Uzbekistan, and what's the recovery picture? What does the graph look like?
Thanks a lot, Chris. It's Odilbek, Deputy Minister of Finance from Uzbekistan. We actually grew in 2020 by 1.7%. So that was lower than 2019 when we grew by 5.5%. But as you know, Chris, we are actually catching up with some of our peers in the Central Eastern Europe and CIS region. What helped us in 2020 was three things. One is diverse nature of our economy. Our economy is roughly split by, roughly one third agriculture, just under one third industry, and close to 40% services. And during the COVID, during the two lockdowns that we had last year, agriculture obviously remained open due to the fact that it's in the field and much less risk of contagion. Secondly, when it comes to industry, we had about 1,000 firms and companies, important. Some of them are state-owned, some of them are not. They started operating, and also we managed to avoid the recession in industrial production as well. Services were hit the most, although eventually services also closed the year with a positive picture. But in the first, second, and third quarters, we had especially second and third quarter, we had rather negative in terms of services. The second thing that helped is the government's anti-crisis policy. So we created anti-crisis fund immediately, $1 billion. And the main purpose was to spend on the healthcare facilities, on some of the most important industries, including subsidies, because we had to introduce some payment holidays for people. And therefore, we basically managed to make sure that the working capital needs of those companies were met by the government subsidies or loans. And therefore, these firms continue to operate. So that's power and utilities, transport services, and so on.
And of course, all of this was taking place, Odilbek, at a time when you're essentially restructuring the economy, a process that had only begun a couple of years before.
That's right, Chris. Yes, and of course, that hasn't stopped. This work hasn't stopped during COVID either. Which I will talk about it in a bit.
We'll come back to that if we may. I just want to hear from the others. Yuri, same question to you. Bring us up to date with what's happening in Ukraine post-COVID.
Yeah, thanks, Chris. So yeah, we spoke like 16 months ago, and it was full uncertainty in front of us. And I must say that very similar to what colleagues said, Ukraine economy weathered this crisis in much better shape than we initially expected. Just to give you the numbers, IMF predicted the GDP contraction of last year at 7.2%. We ended at 4% contraction, and we see a rather quick rebound this year. So one of the reasons probably was that we were very quick to respond in terms of the lockdown, so we didn't have a really big spread of virus. We locked the country from March to May, but in the May we started already opening, and so the economy was not really that much damaged. We also, as a government policy, started to invest much more in infrastructure. First of all, Ukrainian infrastructure was underfinanced, but it was a good substitution by the public investment of some private investments which were put on hold at that period of time. So I must say that on the public side, that really helped, and they added maybe 1 point to GDP in the course of last year on its own. But we see also spillover effect, because better logistics obviously helps, especially given that there are really problems with the global logistics. Having much better grain, which is bordering multiple EU countries, helps a lot. But we also saw very interestingly that one of the sectors which demonstrated the biggest growth in Ukraine was IT. We always knew that Ukraine IT is really strong globally, and there is a lot of outsourcing of big corporates for Ukrainian IT staff. But this sector on its own demonstrated 20% growth year on year in 2020, which was something which we were very much surprised. And now it's between 8 and 9% of total exports of the country. So that's something which we more like structural change we see now, because we still believe that IT and online work will be something of the like new structure of the future.
And what do you see specifically as you look into next year? More of the same?
So we see that this year commodity boom actually helped us a lot. For this year, we see that agriculture also is increasing its share and increasing productivity. We have a record harvest for this year. We see good industrial rebound, but in terms of services, I think that will be one of the key factors of driving our.
Well, on the manufacturing side, we want to talk in a little bit about the whole phenomenon of nearshoring and diversification of global supply chains, which, of course, is a very real factor in Ukraine. But let me just turn to you, Zoltan. You weren't on the panel that the others, the four of us, were on last year. But how is the recovery playing out in Hungary? What were the headline numbers for last year? What do you expect this year?
So same pattern as in case of our neighbors. So contraction last year, close to 5% real terms, and this year we originally thought that we will probably catch up with that contraction, but it seems now that recovery is much stronger. So we are talking probably in around 6.5–7% real growth, plus obviously with inflation, massive, double-digit sort of nominal growth, which helps us on the debt to GDP ratio, despite the fact that the deficit is still relatively high, because the government is supporting the economy and the rebound of the economy. So what worked as in our case is that the vaccination campaign was slightly faster in Hungary than in other countries, because of the government allowed the mixed using mixed vaccines. So we used all kinds of vaccines, Chinese, Russian, as well as obviously the Western ones, and we reached this 55 to close to 60% of vaccination rate relatively early on. It has stalled, but it allowed us to actually reopen the economy faster, and that helped because manufacturing was pushing growth in the first place, and then all these services and hospitality and domestic demand followed in line with the reopening. I think go forward, the big question is, will the global economy in fact slow down on the back of what is taking place in Asia, in particular China? And I think that will drive, the economy, going forward. Obviously, the greatest single enemy is stagflation, and that's what.
Well, we're going to talk about global stuff in just a moment, but just to finish up, just to round up on this topic, I'm not going to ask everybody the same thing, but Attila, I would just like to hear from you, from your point of view of looking at the whole region. Am I right in guessing that the bank and you personally are rather surprised by the speed of recovery and the, notwithstanding the global headwinds that we're going to talk about, the really very positive outlook for the region?
Thank you, Christoph. Hi, good morning, everybody. Yeah, I mean, I think the emerging European region and selected Central Asian confirmed its resilience during the pandemic with relatively strong balance sheets. And this is echoing a bit what we hear now from the 4 country representatives, allowing a strong recovery in the GDP in 2022. And I think the strong starting point for most emerging European economies was the credible central banks allowed monetary policy to also act proactively during the pandemic, and this was something which also supported, in my opinion, very much this recovery which we see. And you are right. I mean, the growth and the prospects are really impressive, and I think even a bit astonishing. Yeah.
And no shortage of new capital for the region. I mean, your job is to win bond issuance mandates from guys like these guys. Investors are knocking your door down to buy the bonds you underwrite.
Absolutely, absolutely. So there is interest, there is a huge interest, and I think this is something which is still promising. We can go into that a bit deeper. I think there is also a bit of a shift probably in terms of the maturity, and I think there are components like as well the greening and the greenium, so a sustainable bonds. So there are certain facts which has to be considered as well. But obviously, yes, you are right. Interest from investor base is huge in the region.
Well, before we all put up the bunting and open the champagne, let's just talk a little bit about some of the things that are a little bit more worrying. Alex, I mean, well, first of all, actually, if I may, Alex, excuse me, Magda, I just want to ask you, because obviously you are an economist, how many countries, talking about, proper countries, sizable economies, I mean, how many countries ended 2020 net positive without a recession, apart from Uzbekistan, which is, Odubek mentioned this. Do you know, just roughly speaking, how many other countries are in that happy position?
Oh, you now called me on the numbers, but I think that is quite extraordinary achievement to have ended 2020 with positive growth, because the shock of the second quarter and sometimes third quarter in many economies, or the second and the fourth quarter of the collapse in economic activity was so sharp that even though we had expected a good, fast recovery for many of the economies, but the decline was so sharp that it was very difficult for any economy to come back to at least the pre-pandemic level of GDP soon after, and even then post-positive growth. So arithmetically, that was very difficult to do. So I think that's quite an achievement for Uzbekistan. So I think there's maybe
do you know any others?
Numbers.
Yeah, single numbers. So yeah, Alex, I'm going to bring you in, although it's perhaps not the question you would want to be brought in on first, but because you haven't spoken yet, I'm going to talk to you, and then I'm going to come back to Magda with the same question, because this is kind of where maybe where one of the tires meets one of the roads. As I look, just for a bit of fun, there are currently 6 billion Google results for the word inflation, and if you time limit it, quite a lot of them are in the last few weeks. Central and Eastern European central banks are not used to coping with this. What are they going to do? I mean, we've seen obviously some of them reacted already. Czech Republic, perhaps most notably. On the other end, Poland saying, wait and see longer. But how are central banks reacting, and how are markets going to react?
Thanks, Chris, and good morning, everybody. Well, it's a question that requires kind of fundamentally a lot of expertise. Looking back at my previous experiences in IMF, economists like Magda, I would say that it is likely that the Western global central banks begin to tighten finally after many years of quite loose monetary policy, there will be pressure on the central banks in emerging markets to respond, because it does feel like when we see these recent shocks, they do propagate, and as happened before. However, it does look like the many countries of our countries of operations have been kind of modifying their approaches to capital markets. First of all, doing more to develop local capital markets, issuing more in local currency recently, which is a good thing. Developing local investor bases, and focusing policies on that, so that and also greening their capital markets or moving to ESG. And we see even issuance by sovereigns of green sovereign bonds. And from
Alex, let's not fire all our ammunition at once. There's
but I wanted to say
three big topics you mentioned there.
Yes. Yeah. So, and then we hear from investors, so institutional investors, that they feel like this should make perhaps make investment flows a bit more sticky this time around. And so as the countries do move more in that direction, we hope that this tightening, when it comes, will be more smooth, let's say.
Okay. So Magda, but back to you. Is the inflation threat real? Is it momentary or transitory, as some have pretended to think it is? Where's it going? What are the effects going to be specifically for our region? And I want you, if you would, to expand on a point which you made when we had a chat earlier, one-to-one. You used the most wonderful expression, which I'm going to shamelessly steal. You said that central banks will not be able to charm reality for much longer. So tell us what you meant by that. First of all, tell us, is the inflation threat real? And then tell us about charming reality.
Yes, thank you. I think overall, the economist's verdict on inflation is still a little bit out. The jury is still a little bit out because of the unusual scale of the inflation shock and the combination of factors that have affected the global and the regional economy. But we can see that the longer it lasts, the longer it may have an effect on a medium-term effect on inflation in the region, and especially in combination with a very solid recovery. So here we are a little bit the victims of our own success when that supply side shock, energy transition shock, breakdown of some of the production chains, the ongoing trade war, all then hit a rather solid domestic demand environment in which it is easier to pass on and absorb the increases in inflation. But I think the threat for now is still fairly material, and it is a very tricky situation for the central banks to manage, and to manage both the expectations, but also then the monetary conditions to make sure that on the one hand, you don't kill the recovery, but on the other, you try to control the undesired effects of both the supply side shock and prolonged low interest rates, which would then only add on to supply side shock. So let's say prolonged low interest rates have had quite a strong impact on the real estate markets. That translates into demand and prices of building materials, furniture, and combined with a supply side shock, so smaller supply, that really culminates in quite an increase in prices and relative changes in prices. So I think for now, we do have to live with the risk of elevated inflation for a while. So as long as the regional and the global economy is almost digesting that shock, but a lot will depend on how we manage that. And I would like to bring this here to the importance of having strong fundamentals and strong quality of policies ahead of the crisis, and not wasting all this accumulated credibility, monetary policy credibility, and fiscal space on this crisis only. It's important to build back these buffers, because there are multiple crises hitting the global and regional economy, and that credibility may only last this long. But also the size of the economies and the depth of the local markets, and actually the greening of the economies also matters, what Alex has mentioned, because it makes the local markets deeper, more liquid, and it also means that there is that buffer of sticky money and also credibility for the local central banks to maintain the more accommodative stance for longer without the punishing effect of financial markets, or a very rapid reaction of financial markets. And you can see that it is not a surprise that the largest economy in the region, which is Poland, has been able to sustain lower interest rates for the longest, given the depth and the accumulated credibility of that central bank.
Okay, I'm going to stick with you.
And also the charming the reality.
Magda.
So I need to explain that, it's probably a bit of a Polonism here, and I'm enriching the English language with that. But I think you said that, I would agree with something you said. I think central banks in the region are actually very used to inflation. Maybe the younger of these bankers are not, but the more senior of these bankers do remember inflation quite well. And it's not only from the transition in the late 80s and the 90s, but there have been bouts of inflation since then as well, also in Hungary and in Poland, and definitely in the countries a bit more east from CE. But it's more that the analysts and bankers in Western Europe are not used to inflation. And indeed, the last big bout was really quite a while ago. So I think luckily for those central banks, that accumulated credibility and the depth of local markets is even deeper. So they do have more space to ride out that wave of supply side shocks. And also the depth of the local markets and even just the more developed mechanism of measuring inflation expectations is a little bit better, so it's easier. But I still think they may be underestimating the confluence of shocks and events that can push inflation for a bit longer, and the shock to the private sector from inflation and generally lower resistance to crisis than in Eastern Europe, Central Europe, or say Turkey, which has survived many waves of crisis and instability.
I was going to interrupt you after Turkey, but you stopped anyway. So thank you very much for that. Zoltan, I pick you just because Magda was talking about past episodes of inflation. And I think I'm right in saying that the highest ever hyperinflation was in Hungary just after the late unpleasantness. Is this on your radar? Are we going to see really a global tightening rate environment driven by the desire to control inflation, or is it all just a bit of talk? I mean, my personal view is that probably unlikely we're going to see real interest rates that all of us, you're all younger than me, I think, but old enough nonetheless to remember when interest rates were interest rates. Zoltan, how do you see this playing out?
So, I mean, obviously our local markets are heavily dependent on core rates, i.e. dollars and euros, government bond and swap yields. So, the movements in those instruments influence our local market yields. Obviously, we have had an increase in yields, but that is just, sort of an adjustment in the negative real yield that we pay on our local market bond instruments. I mean, it's a big question, right? I mean, is this transitory or not? And if I understand Magda correctly, it might not be, or there are risks that basically are sort of preventing this shock to be transitory, and then it's a problem, I guess. So as far as we are concerned in our local markets, I mean, we have a very unique local market because we have a dedicated retail market where we directly sell to retail investors at a positive real yield. which means that obviously our reliance on the institutional market with negative real yields is less. And as a result, obviously we pay higher costs overall on the debt, but it is a lot more resilient and diversified, that portfolio. So as far as we are concerned, we are more or less relaxed about this, but obviously Central Bank of Hungary has a big challenge because they are tightening conditions while they are still supporting the government bond market. So it's an interesting twist, like front and back end of the yield curve, what they do. Gonna be interesting, but what we did, we actually accumulated a lot of reserves in order for us to weather at least the short-term potential shocks if the Fed will in fact start tapering in November.
Thanks, Otto. Marianne, as already flagged, you're the Eurozone representative here, so it's a slightly different picture. But I mean, it's a very simple question. Are we entering a true rate tightening cycle, or is inflation a transitory phenomenon?
This is $1 million question, I believe. So I would put it this way: there will be central banks which will need to actually tighten. So Czech Republic Central Bank already proved that. Then there will be central banks which will want to tighten when possible. So they will be aware, or they are aware, that actually removing the stimulus and deploying the stimulus when needed is a monetary policy, actually flexibility, monetary policy capacity of central banks, which can help really in appropriate way to support the economy. And then there will be central banks which won't be able to tighten because they might not be independent enough, and they will need to actually preserve credibility in a different way. So in the Eurozone, I'm afraid we will be facing this situation. So Eurozone Central Bank, which is ECB, will actually need to look across the member states, across the Eurozone countries, and to see how more aggressive tightening would affect them. So we should expect a couple of calibrations going forward, and also we need to actually find out later in the process how actually structural these inflation pressures are in the Eurozone. So now we are having the base effect, so the so-called pent-up demand coupled with supply actually bottlenecks and other factors which are actually feeding into these high inflation readings. But when we are done with that, when we move actually into the period where actually base effect is actually eliminated, when this pent demand is exhausted, and then we are left with other factors which are feeding into this inflation readings, and we will need to go from there. But for Americans, for Fed, I will tell you, they will want to remove the stimulus as soon as they can, because this is how they do monetary policy. This is how
they always go quicker, harder, deeper before anybody else.
This is paying off. It is paying off, and Christopher, I would like to add here. I mean, the European Central Bank would need to find out what is the appropriate way to get from the negative depo rate when they can, because this would really help the financial system without detrimental effects this is having for it.
Alex, Marianne, thank you, Marianne, has mentioned the US very explicitly. There's some big numbers out this week. Labour numbers are due out on Friday, which will be a signal everybody's going to watch quite closely. And of course, we are being treated, not for the first time, to the show of will Congress raise the debt ceiling? Will the United States default on its sovereign debt in about 2 weeks? How are you looking at all of this, Alex?
Well, we, our country's operations are going to be affected by the moves in the US, most likely, no matter what, perhaps with the exception of the EU, Eurozone countries. And of course, it requires deep insight to know whether this time is different and US would default. History shows that the US always walks back from the brink because it's such a potentially destabilizing move. So it hasn't happened. There were previous situations of this nature over the last 2 decades, and the moves were always favorable to the market. So I think that really it's probably indeed the state of the economy, the growth in the US, and the potentially approaching the growth potential that would lead to the increase of the interest rates eventually, and that probably, as we discussed, would transmit itself to our countries of operations. So we're watching it closely, but our main goal really of my team in EBRD is to really help all these countries to develop their capital markets, to make progress. As we discussed, to make sure that this time is different for them, that they're more resilient, and we can discuss it a little more in the further.
Yeah.
I know.
You mentioned this question or this point once or twice, and it is a perfect link, Yuri, for me to bring you into this discussion and ask you what your inflation and global rate environment expectations are, by all means. But specifically, someone in the audience has obviously been taking on board what Alex is saying. Dennis Shen is asking about Ukraine's strategy to enhance liquidity in the domestic debt markets to create greater resilience. So, general, global, your view, Yuri, and then specifically this domestic capital markets point, which we keep mentioning.
Yeah, thanks, Chris. I must say that contrary to our colleagues, we are not really that much scared of inflation because we have much more recent memories, right? Ukraine had its own non-economic driven, but in the end of the economic crisis in 2014-15, and we came down from double-digit inflation only in 2017. So we were properly warmed up when everything started, right? So we were the first country, I think, from emerging markets who raised the policy rate back in January this year as a response to the increased inflation. So totally the rate was hiked already 4 times by the central bank this year. And we believe that this month and next month will be the peak month for inflation, so it's going to go down. So domestically, we have everything under control. We also help with a very quick fiscal tightening to curb inflation. So we come back to the primary surplus next year already with deficit target of 3.5%. So pretty much doing what like standard economic textbook says what you do in fiscal and monetary policies normally. But speaking about global sentiment, right, I would say that that's something which is more of our concern. We see that Fed is actually trying to carefully manage their messaging, not to end up in situation of taper tantrum as they've been like 8 years ago or 9 years ago from now, right? So, but still it's inevitable. And we see already that this global party on the markets is pretty much over. There are no new sovereigns coming to the market this week. I think after Nigeria and Egypt, there's proper hangover on the market already. So I think that further on we will see investors being much more selective, and doesn't mean that they will go only to IG names, but in any rating category they will look at the better countries, not just poor liquidity to everyone. And from one standpoint, it's worth to be the best one in our category, right? And we are trying to do it with all this very prudent fiscal and monetary policies. But what is also important, what Zoltan was saying, we see the same effect here in the developing of the local market. Ukraine local market probably is the quickest one in terms of developing in the last 3 years globally. We now borrow most of our funds domestically. We have good international investor participation. When I started here in 2016, the longest bond we were issuing probably was a 1-year bond. Now we successfully placed like 6-7 years bond domestically, right? And have the desire to go longer. So that's something which matters a lot, right? The only way pretty much to be less affected by the global sentiment towards EM is having really strong local market and strong domestic market with domestic investors in the first place.
And you mentioned that also international investors in domestic markets, but from the point of view of domestic investors in domestic markets, are there some new developments in social security, pensions reform, things like that, which will drive a greater sort of maturity of a local buy side? Is that something that's a matter of policy or something that you're aiming to achieve?
In the midterm perspective, yes, but if you look at Ukrainian financial system, it's very bank-oriented. So 96% of all financial systems are the banks. So pretty much the redistribution of the wealth from the population happens through the banking system. What we were doing, because when we started, we had a situation when international investors were playing in their own part of the market, trading longer bonds, and domestic banks were like preferring like 1 year, 2 year bonds. So we tried to bridge the gap and we moved everyone to the same territory. So now we see that both there is significant liquidity in the middle, and both domestic banks and international investors are trading the same bonds. We promote it even further. We move to more like benchmark bonds. We wait for the index inclusion to be GBIM eligible for the first hour bond, and then we'll add, similar to Egypt is doing, like what Serbia did. So we're doing pretty much a lot to develop the local market, but with the goal not to have the need to be present at the Eurobond market every year in principle.
Thank you, Yuri. Attila, I'm sorry, with so many of you, it takes quite a long time to get round to everybody. But Attila, you do you have any optimism, assuming that you think it would be a good thing? Do you have any optimism that the era of negative interest rates may soon be over? So I'm turning the same question around slightly. Negative interest rates have not been terribly good for Austrian savers or savers anywhere. Are you optimistic that we are reaching a tipping point? And how dangerous is it? And 2013's taper tantrum, is that just a bit of history and we can forget about that kind of thing recurring?
No, yeah, I mean, look, nobody has the crystal ball, but being on the origination side, you still need always to be on the optimistic side. Otherwise, I mean, it's not the right job to do. So I would tend to say yes. Basically, optimistic. It's what we see currently is certainly that investors are becoming certainly more choppier. They are looking more into also the fundamentals of the issuers, you know, and I mean, coming to the rates and if we turn into positive yield territory, I mean, I hope that yes, maybe we will have a kind of end of this, but to be totally true and transparent, I'm not sure if this will happen so soon. Yeah, I mean, optimism is there, but I mean, I see. In the end, you know, that we don't see that this might be really in a very soon moment. Yeah. So overall, you know, I mean, in the yield environment, I think the pressure will be certainly on the long end maturities now, and to this extent, I would see more now in the current market environment, the issuances for longer term papers now becoming more difficult. Investors with the current environment are more selective, looking more into the fundamentals of the credits, and in this respect, I think it's also a good sign for the panelists here, because they have, compared to their peers, very strong fundamentals, and this might be more encouraging. But overall said, I think the rates environment still remains challenging.
Challenging from the point of view that it's going to be lower for longer, that phrase that we were using a little while ago. Attila, you mentioned earlier on, we were talking about investor appetite. When investors are looking at these kinds of credits that we're talking about here, are these sort of global macro things in the back of their mind? I mean, obviously, yes, in one simple sense, but do things like worries about inflation and the effects of a global tightening rate environment, are they playing into market activity, or is it all just kind of in the background and people are getting on happily, business as usual, what they've got used to over a period of, quite some number of years now, 13 years or whatever it is?
Yes, no, I mean, it depends, and that's certainly difficult to say if this is something to stay for longer. Yeah, we think that it will not be only for shorter time period, but it will remain a bit, and we will see obviously that the investors will look much more carefully to what credit they invest and how the fundamentals are compared to peers. I think in previous times, and you mentioned the previous years, obviously liquidity was abundant, and people and investors went simply for getting longer dated papers with higher yields, and we saw that I mean, Serbia, by the dual tranche, they went for a 15-year tranche as well, which was the longest one, and they successfully raised with a kind of a strong book. But I think now with what we see currently and as well today in the markets, it seems that it is probably not a turning point, but it is a kind of a wake up that things might not continue all the time like it has been and like we have been used over the past years.
To use Magda's phrase, the charming of reality may come to an end. Odubek, you are physically the closest of all of us to China. So I'm going to ask you to comment. By all means, give us your views on the global rate environment. We've probably talked enough about that now, that there is in the air at the moment this sort of sense that we might, potentially a sort of gigantic liquidity event might be about to happen. I'm talking obviously about Evergrande and their $300 billion of outstanding bonds. And I saw that another slightly smaller Chinese firm in the same sector had defaulted this morning, or missed a payment at least, and suspended its shares. Are you closely following the Evergrande story? Will it in the end just be a hometown stitch up and the Chinese will sort it all out? A few people will get shot around the back and that'll be back to normal? Or how do you see this playing out potentially?
Chris, I'll be honest, I'm not following very closely this Evergrande story apart from just observing it in the media. But my view is that having seen 3 separate crisis events since 2008, this is not going to be a massive one that we've seen, what we've seen in 2008 after Lehman collapse, or what we've seen Eurozone debt crisis of 2010, 2011. This will, and the Russian crisis, of course, was much more local compared to it didn't have a material impact on the markets. So I'm of course, the numbers are very, very high. $300 billion is a lot of money, mostly debt funded. Of course, bond investors will lose from the current stance of the Chinese government. And of course, this will impact the fixed income markets and potentially EM appetite towards EM investor appetite towards countries like Uzbekistan or other private sector players. Therefore, in my opinion, this will have a negative impact, of course, on Asian debt markets, but it will fall short of being a global crisis that we saw in a much larger countries or much larger markets. Another point is that the fact that Evergrande or other Chinese borrowers coming and defaulting is not news, Chris. I mean, this has been around for the last 10 years, 15 years. People are talking about Chinese municipalities, Chinese railway, the construction companies, so on and so forth. So it's basically for the 10, 15 years, people knew about this problem. This was in a way known unknown. The only issue that was unknown was timing, when it's going to explode and how the Chinese government will react. So at this very moment, I mean, putting my former DCM hat on it, if I was in Hong Kong or in Singapore or in China itself, I would be very very upset and angry, perhaps. But from the global liquidity perspective, I would say that there will be a solution, there will be resolution, and soon after, EM will be back to normal.
Okay, good.
Back
right,
on business.
I wish I could find somebody on this panel that was actually worried about something. Everybody's takes a very benign view. Ulubek, one of the things you didn't mention about Chinese debt problems having been around for a very long time is, have they yet got a bankruptcy law in China? You don't have to answer that. It's a rhetorical question.
Chris, I don't know. I mean, we are close. I must say we are close geographically, but we're not as close as some countries are. We don't follow China quite closely.
And here you are on a panel that's headed Central and Eastern Europe. And you are, despite being one of only 2 double landlocked countries in the world, you are physically very close to the extremities of Europe. So you're definitely European as far as everybody on this panel's taxonomy thinks about it. I'm going to stick with you just for a second. And we've got a good half an hour or more left, 40 minutes or so. So I'll get the opportunity to ask this question to each of you about recent market activity. But you're, the relative new boy in terms of global bond market issuance. You've done 3 issues so far. I hope I'm correct in saying that. You did most recently dual currency.
Yes.
Was the dual currency element of that aimed specifically at this local markets development stuff that Alex and Yuri and others have referred to?
Yes, very much so. So we are behind the curve, as I mentioned, compared to some of my colleagues on the ground. And I spoke to Yuri last year, I believe, in terms of bringing more foreign investors into our domestic market. So the local currency component, this was the second time. First time we issued November 2020, 2 trillion sums. Then last year, in July, was 2.5 trillion sums, a 3-year maturity in both cases. We want to ensure that investors get used to the name, right? Some Latin American countries, they've done it before. So they've issued local currency Eurobonds. Even in Central Eastern Europe, Middle East and Africa, they've come and offered their local currency bonds. And until our infrastructure is ready, until we have the connections and bridges with Euroclear, when investors can actually buy my local currency paper sitting in London without opening anything in Tashkent, I want to issue and make sure that I develop the investor universe for Uzbek sum denominated bonds. And that's one of the reasons why we continue doing dual tranche. Another important element of the previous transaction was it was under the SDG framework. We've also developed sustainable development goals, ICMA compliant bond framework, and this was the first transaction of this. And we just wanted to also target the SDG investor universe. Somebody mentioned earlier that green bonds and other sustainable SDG compliant bonds, something that we are also thinking offering, because again, this is an attempt to diversify our investor universe globally, so that at times of crisis, at times like we may potentially see when the rates rise, when there's a taper tantrum, or when investors will be shorting EM, we would like to make sure that there will be loyal investors who will be following us.
I'm sure. You're currently BB minus.
Correct.
Are you expecting any ratings action in the near future?
Near future, apart from outlook change, we're hoping, but it's not expected. I mean, because a couple of things that keeps us in the BB minus category are low GDP per capita, and it's very difficult to change, even if you grow by 6-7%, and your population is also growing.
Yeah,
and it's quite difficult to change and get to that BB plus or BBB category. Yeah. Another thing is our institutional rankings or institutional ratings, unfortunately, which rating agencies do take, and rightly so. They take this into account as well. So institutional rankings, although they have been improving and the government is paying quite a lot of attention to it, it's also quite sticky and mostly perception based. You can change the facts, but perceptions do remain, and therefore now we are sort of in this phase. And by the way, our corruption perception index has obviously improved. I mean, we obviously gone up by 9.9 positions in the last year. The progress is there, but it's too slow to trigger this rating upgrades. But hopefully in the medium term, yes.
The population growth in Uzbekistan is, of course, an important factor, important attractive factor. It means you're not going to run out of labor and you're not going to run out of consumers. So, but
not in the next 5 decades, no, Chris.
It doesn't help the GDP per capita. Marianne, we've touched on ratings there. I'd like to ask others in the panel if they would like to talk about their ratings, but I know you have a particular point you wanted to make about this. So tell us what that is.
Yes, indeed. Actually, Slovenia has, I would say, most split rating among, I would say, sovereigns still. So it enjoys AA- rating with S&P with stable outlook, and A3, which is A- rating with Moody's. So this is still fairly split rating. We are happy that rating agency Moody's did increase the rating of Slovenia last October to A3. So this closed the gap to a certain extent, also from the point of view that our third rating with the 3 rating agencies is A with Fitch. So we see going forward, after we are actually examining or rating agencies examine what is the economic situation in countries across Eurozone where Slovenia actually compares, and to see that there are rationale for the rating upgrade. I need to point out that there were 2 reasons why Moody's during the COVID crisis increased the rating of Slovenia. So one is the highly liquid, highly capitalized, and robust banking sector with a capacity to actually support the Slovenian economy going forward, and also the work of the Debt Management Office, which is Treasury Directorate, in the context of reducing the interest the budget is paying to service the debt. So and where the work of the European Central Bank was instrumental. So we did execute a lot of liability management transactions, which was very, very positively actually received by rating agencies, especially by Moody's. They put this in their report explicitly, and I believe we will have, I would say, thorough discussions on Slovenia economy fundamentals going forward, and I expect that rating with Moody's and Fitch could potentially improve going forward.
Okay. Zoltan, Yuri, does either of you want to talk about your ratings? You don't have to. We've got lots of other things to talk about, but if no blame if you don't. Do you? 3, 2, 1. Oh, you turned your microphone on. Zoltan.
Yeah, to politely decline to talk about that.
Oh, okay, fine, right. Well, let's move on to something else then, and let Yuri, unless you have a burning desire to talk about your ratings.
Oh, not really.
No, okay, good. So, Magda, I'm going to turn back to you. One of the questions I put in this sort of list of talking points that we're all kind of loosely working from is, can we see any evidence in the region of people not wasting a good crisis? That old thing about, never waste a good crisis, use difficult times to get perhaps difficult things done. I want you to make a general comment on that, but also a specific point, which I have to say I find very, very interesting, and touched on it already, mentioning China and in Yuri's comments earlier on. The whole potential for really significant benefits for Central and Eastern Europe in nearshoring, onshoring, shortening global supply chains, or multiplying global supply chains, disengaging perhaps to some extent with China from that point of view, if not others. Tell us what your thinking is on all of that, please, Magda.
Yes, on not wasting a good crisis, I think we still have to wait possibly for some of the results of that. But I think overall, this was a good almost exercise to practice certain policy tools that have not been tested in most emerging markets and CE, for example, the use of unconventional tools by the central bank, the introduction of QE, and simply getting the market used to that, and knowing that the central banks in our region are not anymore these price takers and only reactive to what's happening in the global economy. So, but rather graduating into the tools that are used normally by developed market central banks. So I think that's actually a certain positive legacy of this crisis, and the discussion of whether these countries should behave as emerging markets, or rather, should they be really behaving as developed markets, and do they have the tools to behave and trade like developed markets? And I think that's a good use of this crisis. And obviously also the discussion about the relationship between in the labor market, and which is ongoing also in the developed markets, and the pay, the salary, the incomes, discussion about the importance of flexibility, the overall social contract that was triggered by the pandemic, I think is a positive aspect of the overall crisis. On your second question, I think the region is very well positioned to actually benefit from the ongoing trouble and the separation of global production chain. I'm not saying it's going to be absolutely positive, because the breakdown or separation, say, between China and the West, and maybe a potential creation of two trading blocks with Western Europe, US, parts of LATAM and parts of Asia in one, and then China, parts of Asia, maybe Africa in another block, is not going to be good for the global economy, because it means increased transport costs and just increasing some inefficiencies and a larger reserves in the global economy. But if that really happens, then by the virtue of the both geography, then political connections, and then also existing trading links, this region is very well positioned to tap into that capacity that could be freed by some of the breaking of links with Asia and other regions. So I think that's an excellent opportunity to capture for our region. Obviously, the challenge here is that you don't want to be stuck in a low value added production. It's not really, while the production of white goods, consumer goods, is almost a moneymaker for the region, it is really the production of higher value added, technologically advanced goods that will both bring higher incomes, but also will insulate the region from getting stuck in old technologies, right? So currently, for example, CE3, CE4 actually is heavily dependent on production of cars and car parts. But as we know, the combustion engine may be a thing of the past. Only the most efficient of them will survive. So we're moving slowly towards electrical vehicles, and getting stuck with a stranded asset of an old factory is not exactly the best thing for the region. So I think it's a
moving slowly may
but
be
a
the
massive
operative
challenge.
word. Moving slowly may be the operative word. Alex, this is exactly the kind of thing that the EBRD obviously studies, looks very closely at. Shortening of supply chains, diversification, reshoring, nearshoring. Is this a big thing for the CE region?
I was planning to come in more on the not wasting a good crisis.
Okay, well,
the market development side.
Maybe they're the two facets
sort
of the same thing.
Related topic, I think. I mean, generally, by the way, I'm speaking now from the region. I'm on my first trip since the COVID crisis, visiting 5 countries, including Ukraine. I'm now in Poland and the Baltic countries last week. And I must say, in general, it's quite impressive how resilient the countries have been in terms of real economy. There was quite a rebound. So some countries like Estonia are going to have close to 10% growth this year, which is really incredible. But in terms of not wasting a good crisis, we do feel generally quite hopeful, let's say, that in terms of reforms and various activities on market development side, we have seen quite a lot of activity even during the COVID crisis. So we saw countries continuing reforms on, derivative legislation, introducing new products like covered bonds, greening, as we discussed, greening of the capital markets, and multiple countries on this panel, introducing sustainable products, green products, including using sovereign or sub-sovereign issuances. And we launched as a bank some new products in our region. They're very common maybe in the West, but for example, commercial paper in the Baltic countries, and the central banks of the three countries issued an MOU indicating that they would come in if needed to support this type of commercial paper market. So as Magda mentioned, it's actually maybe one of the first crisis where emerging European or emerging market economies, including in Central Asia, were able to behave a bit more like advanced markets, where they had liquidity injections. They actually were able to help stabilize markets and enter the product space. So generally, it's been probably a reasonable crisis, and we are there. I will tell more about what we can do later, but I think we've seen not so far so good, let's say.
Okay, good. Thank you very much. All right. Yuri, I want to we talked a little bit about nearshoring in the Ukrainian context already. So what I'd like to ask you now, if I may, and we're down to, coming towards the end of our time, you did a $500 million tap in July, successful market operation. Are people still focused? I mean, investors and bondholders, are people still focused on these questions, which have been around for quite a long time now, of the completion of the IMF disbursements and the, let's say, the robustness of the judicial banking review? These are two things that still come up whenever anyone looks at any research on Ukraine. Are those things that investors ask you about, and what's the news on those, please?
Look, so yes, they are, and I must say that those questions on IMF program are being asked for the last 4 years in different shapes and forms due to the different programs. Like answering the question on IMF, obviously we have mission in town now, so I cannot comment a lot. There will be public statements from them, hopefully in the course of this week. I would more tell on the fact that having IMF program for the country makes investors really extremely lazy. If you split the questions you get from investment community, so probably 80% will be about like any outstanding prior action on IMF, 20% will be about macro story or balance of payments or inflation or like debt projection outlook. So I'm really jealous with what my colleagues have to answer normally on investor calls, when you can deep dive into how economy works and people actually can analyze whether your country is like better or worse performance or what are the global trends. With IMF actually in place, everyone tries to just tick the box, will be their disbursement of IMF or not, and think that their job is done. So that's kind of on the downside. But obviously we are, like seriously speaking, we are in the program which has $2.9 billion of cheaper money than we can get on the market undisbursed. And we obviously are aimed to get all the $2.9 billion. And that will affect our next operation. So that's we were not really active on the market this year. We did $1.75 billion bond only, and for the next year also we have rather modest plans because actually IMF money at the moment of time are cheaper. Once we come to the situation when our borrowing, as most of our colleagues here on the panel who borrow cheaper than IMF provides, once we come to that situation, obviously the story will be different.
You haven't mentioned the continuing questions over the judicial banking review. Is that something you want to comment on, just to bring people up to date?
There are not much to add. The judicial reform was like done in terms of legal actions. So now what we do is obviously the painful implementation, and changing the judiciary. It really takes a lot of time. So now we're in the process. On banking side as well. So we voted everything in the parliament. It being applied, it takes a year to implement a lot of these provisions to the banking system because it's pretty much bringing them to the more closer to Basel III requirements, so there is some transition period. So there is work, it's not of the concern, it's just a process which has to be done.
Sure. Okay. Attila, all of these sovereigns are, of course, actual clients and potential clients for you. And in your DCM role, talking to these guys about what we're talking about now is exactly, straight down the middle of the fairway, let us say. But what are you advising people as we go in, we start thinking about 2022? What are you advising some of your clients are the kind of sweet spots in terms of how to borrow, when to borrow, where to borrow? What is your advice for the clients you have here on this panel as we start looking at next year?
Look, what I think, I mean, in terms of what we heard from all these prestigious issuers, and is that they develop as well the local markets, and obviously here we as Wi-Fi and we have as well kind of a view and want to support here the countries, because most of these countries we are as well active and present with a network bank there. And I think what has been said, obviously, to attract also non-resident investors into local currencies, they are looking for benchmarks, they are looking for liquidity, therefore they are looking for size. I think something which is also is in the secondary, a well-functioning primary dealer system is tremendously of help as well in this respect. So developing the local currency market is also, and this is what Odilbek and I think Uzbekistan did very well here in the recent past, is also having issuers coming to the market, coming to the international markets as well from the financial industry, for instance. Yeah, I mean, this all maps the country and the local currency to international non-resident investors. And I think that's one point which I wanted to express as well. Then I think obviously as advice is don't forget, and all of these issuers are looking into the green and the social component and the social formats. They have printed transactions, I mean, in Hungary very successfully, also on the local market. So it's not only an international game, it's also what local investors are looking after, and that's something where I see the biggest potential as well, where probably now that still investors are eager to get exposed to this green and to the sustainable format, there is a lack of supply, which I think maybe will remain, but probably is also something where you can now generate best green minute and generate